because the kind of stuff that I'm looking to buy and continue to buy right now are those long-term, buy and hold that you can value add over time, but that you're not relying on get in, get out in 2 years, to make your money. And a lot of those owners are pretty resilient. They're not really selling for the prices I want to buy it. But every market's different, and you're going to have huge opportunity if you continue to look. Just be patient and buy what makes sense today, but no more opportunity is likely coming around the corner, and you got to be patient to only do really good deals.
Alrighty, folks, it's been a minute since we've caught up with the one and only Anna Kelly. We're going to talk Fed, inflation, jobs, big, beautiful bill. We'll even close with what the heck are we doing on our individual portfolios in this time of opportunity. We'll talk about a Fed article from New York and San Francisco talking about rates going back to zero. Yes, I said zero. But we're going to open with a conversation I had with the one and only Ken McElroy yesterday. The video is premiering Tuesday at 11 a.m. Pacific. Anna, how you doing?
I'm doing great. Good to be back with you. Lots of stuff going on.
Yeah, absolutely. Love to have you back. People love you. Actually missed you. I got a couple of notes. Where's Anna? So they really love our conversations. But I had a great conversation with Ken McElroy yesterday. It's going live today at 11 a.m. Pacific. And we had an opportunity to talk about where we are in this kind of pain cycle, right? And specifically, we'll talk about multifamily first. Basically, Ken is saying that the Class A, the tippity top stuff, has already had their adjustment, 20-25%. That stuff is trading, moving fairly well. But then we got to where I'm interested, Class B and Class C. And we had a big, long conversation about that. And the net of it is Ken says that we might be in the third inning. He is starting to see more and more banks and really more and more syndicators cry uncle. Seems like a lot of foreclosures are coming. And Ken said it could take 18 months to kind of flush out the pain. And then, of course, for me, because I didn't play in that space, the opportunity for wealth building. So Ken, I was pleased. Ken thought we might be in the third inning of this pain cycle for Class B and Class C. Does that kind of fit with what you're seeing?
Yeah, I think we talked, and I look forward to the conversation with Ken because he's brilliant. He has way more experience in terms of volume and breadth and time in multifamily than I do even. And so he's really smart, and he's been through, quite a few of these adjustment periods. So I definitely agree with them that there's more pain ahead. I think for Class C, we're further along in that, 3 innings just personally, because I think a lot of the banks have already started to foreclose on those Class C assets, because not only did the cap rates adjust and the value on paper fall, but they've really struggled to get the rents up sufficient to cover the increases in not only construction costs to execute their value add, but also just the cost of insurance and taxes has skyrocketed 300-400% in a lot of these big cities where a lot of the syndications were done. So banks have already called those for non-payment. So I think Class C, I would think, is probably further along, maybe the 5th inning. But Class B, I think I agree with Ken that it's kind of in that 3rd inning. And Class B tends to be pretty resilient. One of the differences between Ken and I, although I've done large deals, we have apartments that are 500 units, plus in big cities, is that he really focuses on only the big stuff.
Oh, yeah.
Where you and I also have bought a lot of small multifamily units, mid-sized multifamily units, under 100-unit properties. So I've got a portfolio of about 300 that are small, 10s, 20s, 30s, 90s, 70s in that space. And so you see a lot of those properties that are Class B properties that have already had some value add done to them, where they're owned by smaller investors that are using small banks. And sometimes they're able to get those rates locked in for a little bit longer. And a lot of those assets, Michael, are held by real buy and hold landlords like us, not by the syndicators that are flipping them. So the reality is a lot of those Class B assets, especially in nice areas, they have good loans on them, and they have small banks willing to say, hey, you're cash flowing. You've got a good 20-year mortgage on that thing. And maybe they'll modify the loan, rate, or they'll let them, even though the rate is resetting, they won't make them, go back through underwriting to see if the value's still there. As long as they're making those payments, they're good. So I don't really see a lot of distress in the smaller Class B assets that are buy and hold deals. In fact, a lot of landlords are just holding on to them. They have no need to sell because they bought them right several years ago. The values, sure, they're lower on paper, but they're pretty resilient. They're cash flowing and doing well. So Class B, I think, is early on. And I don't know that they're actually going to crash to the extent that the Class C big apartments have and Class C small apartments in their value at all.
Yeah, it's going to be really interesting. Ken was very specific. He was definitely referring to the Class B value add story.
Yeah.
Right. The stuff that the people that were forced to take out bridge debt, short-term debt to make the numbers work. He was very focused on all the new syndicators who came into the space with really no experience. Right. Ken, like you said, has got 30 years in the game, thousands and thousands, I think 10,000 units, something like that.
Yeah.
And Ken being, he even quoted Warren Buffett, I think a couple of times, when the tide goes out, you see who's swimming naked. And he's like, dude, there's a lot of people swimming naked. But when you flip the coin over, he's active, right? He's buying now. He actually said he's buying and really focused on North Dallas is an area that he's looking to scoop up some properties. So again, Ken McElroy's making moves. He sees big wealth generation in the next 18 to 24 months. So I like being over the target. So I'm excited.
Absolutely. And the reality is when properties are on sale, right? The fire sale that happens only in these cycles every 18 to 20 years or so, that's when you have the opportunity to really make generational wealth changes. I mean, we made a lot of money in an expansion period, as people always do. But then you hit that peak and things start to correct and people lose a lot for doing things like bridge debt or not understanding where we're going to go.
It's always the debt, right, Anna? It's always the debt.
Always the debt. Absolutely. And so that's really the story, that if anyone learned one lesson from 2008, 9, and this cycle, it's put good debt on properties. You got to hold them long term. There's a time to flip, and value add is just a flip on steroids. It's like a house flip, but you're flipping several hundred units. And when you're expanding, it's a great time to do that. And you can afford to use some variable debt during a flip, like all people generally do on a flip, but you got to watch those peaks. And when you start to see them, the warning signs are there a year or two before easily. In this case, it's been 3-4 years since we started to see some of those warning signs. You've got to shift the debt that you're using, and that bad debt and overpaying for properties and the costs increasing is really that kind of triple whammy that's allowing people like Ken to go out and make huge gains over the next several years as the market stabilizes. And for the small investors, I'd say we're like medium-sized investors, you and I, but for the small investors to medium, all the way up to large, there's huge opportunity in certain pockets. And if you can find distressed, motivated sellers, which is, really where you get a good deal, you make money on the buy, and you got to make these, you call them ridiculous offers, right? Or
disrespectful
offers. You've got to buy right. And if you buy right and you put good debt on it, you can cash flow and hold assets for a really long time and weather these storms. So I'm excited, that we've got some opportunity. I haven't found much that is sexy enough for me to buy it with the prices, because the kind of stuff that I'm looking to buy and continue to buy right now are those long-term, buy and hold that you can value add over time, but that you're not relying on get in, get out in 2 years, to make your money. And a lot of those owners are pretty resilient. They're not really selling for the prices I want to buy it. But every market's different, and you're going to have huge opportunity if you continue to look. Just be patient and, buy what makes sense today, but no more opportunity is likely coming around the corner. And you got to be patient to only do really good deals.
Yeah, love that. Well, I'll give you one more tease from the Ken McElroy video. Again, by the time you watch this, it will be live on the channel. He had a post on IG, Instagram, and X, excuse me. And I thanked him for this, because this is something I preach. Here we go. One door is better than none. You do not need 100 to start, just one.
Yeah, really good. And he's still saying that after having 10,000 doors and, billion plus assets under management and more, experience.
Yeah, he said he thought he had $1 billion just in equity. So he's got billions of top
he and
line.
his investors.
Yes,
but a lot of money, a lot of experience. But that's really the important thing is you get started, and don't believe that bigger is always better. It's really, the syndicators who rely on that for their income, many of them over the last couple of years have shut down. They've gone back to work. They're really not making money because they make most of their money on the exit,
On
and they
fees
can't
and
exit
well,
right now. But
no, they can't.
us, we built our wealth through holding smaller properties that cash flow and allow us to weather, periods where things slow down transactionally and to do really, really well. So you only need a few over your lifetime to really, think about it. If the average house is $300,000 to $400,000 today, depending on your market, I mean, you pay off those mortgages over 20 years, even if you did nothing else, 2 or 3, you'll have $1 million in equity in 20 years. And so it doesn't take very many to really slowly, methodically build wealth. And that's what you and I, teach on this channel constantly. So it's nice to hear Ken say the same thing, even with all he has, that just get started and do a good deal and then keep doing good deals slowly but surely. And that's how you create wealth.
Yeah, I'll give you one more tidbit because it's here. He actually talked about his sister, who all she ever did was buy 5 single-family homes, over the course of 30 years, and she's retired now. Has an equity position because they're all paid off of over $2 or $3 million. So again, folks, all you got to do is get to 4. Get to 4, and life gets better. All right, we're going to talk Fed, inflation, jobs, big beautiful bill, and some more stuff. Let's start in the order that it happened. We'll go with jobs first. Right, we got a jobs number last Thursday, right before 4th of July. Happy 4th. That, frankly, on the surface was better than expected. On the surface, took away any chances of a July rate cut. But like a lot of jobs numbers the last year, the number was dirty. It included roughly 50% of the job additions was government jobs, not federal, but state and local government, which is not normal in the June report. So, I don't know. I think it's time to call BS on the strong jobs market. It seems to be weaker, but unemployment actually fell. It was supposed to go up to 4.3. It fell to 4.1. What the heck? Is the job market strong or not, Anna?
I would say at an aggregate, the numbers look like it's a strong job market. But again,
I love the quotes. It's strong.
Air quotes for any of those listening and not paying attention, right? But the reality is what's really happening under the hood. And that's what, you and I've been talking about quite a bit. And a lot of really good economists like Stephanie Pomboy and Daniel DiMartino Booth, they really dig under the hood into those job numbers. And one of the things we talked about, it's gone really fast, right? But the end of 2023, through 2024 is that anytime that you have anytime you have more than 10% of the new jobs created by government, you've always historically been in a recession, more than 10%. You just said 50% were government jobs. At the end of 2023, even though we technically had positive job numbers, Michael, 25 to 30% of those jobs were government and then healthcare. And that's why, these SOM rules and these unemployment measures that measure, where are jobs and where's unemployment and what's the percent of change month over month of those things that have been a perfect, historical indicator that we're in a recession, not unlike the yield curve. It shows us that the private sector, which is what's really important to understand, is not doing well. The private sector isn't hiring. And in fact, we're finally starting to see that rollover that happens in a lot of recessions, Michael, where there's kind of a progression of when you get into a recession and you have housing go into recession, you have orders start to fall, you have profits start to fall generally in companies, the breadth of the market. And then and only then do you start to see employment falter. And we're already seeing that employment falter, but the last leg of employment to falter is usually services jobs. So we have goods, manufacturing, construction, they start to lay off. And then finally you get consumer discretionary layoffs, and then you get services sectors. And we saw a lot of service sector layoffs. So we're seeing all the things that happens in a recession and in a weakening economy, but people need to remember that employment is the very last domino to fall anytime you're in recession. So the fact that we're starting to see under the hood that the employment numbers are not really that great. The other thing with unemployment is even though the unemployment rate has fallen, the number of people that have fallen off and no longer can get unemployment and are still looking for jobs, or they're holding multiple part-time jobs, that number has gone up significantly and it's not counted in those numbers. And so really there are more people unemployed or underemployed than that 4.1% represents. And so it's just one of those things we have to understand. This is just a snapshot in time. But if you look at the trajectory of how these things happen, it's not a good sign that everybody wants to hope, hey, there was a better print, so it's a good sign that the economy's strong. It's really not. Not at least for the private sector and that middle income and below. It's still strong for the wealthy. It's still strong in terms of the stock market, but Wall Street and Main Street are very different things.
Yeah, no question. Well, let's go to inflation next. Obviously, the Fed, specifically Jerome Powell, has been very, very clear. He expects an ugly return to inflation. Frankly, this print, which was next Tuesday, he expects the next 2 months to be iffy. Also, he's talking about tariffs, and frankly, the date keeps moving. It was, July 9th. Now it's August 1st. We got a bunch of 40% tariff letters going out yesterday. Is it negotiations? Is it not? We'll see. But, the Fed's been very clear. They would be cutting already if not for the tariff noise. And of course, we had some Fed presidents like Christopher Waller, Michelle Bowman talk about July possibilities. Probably not now. But where do you come down on inflation? Do you think we're going to have a return to inflation or what?
It's very difficult to say. I'm going to give an opinion. I think it's a little above my pay grade on this about tariffs, right? But generally speaking, and this is a different world than the last time tariffs were put in, and a different world than the time before that. But generally speaking, you have kind of a one-time price adjustment for tariffs, i.e. short-term inflation. And then generally companies are forced to take profit cuts. Consumers refuse to pay the additional cost for things. And that actually ends up being deflationary long-term because companies can't demand higher prices from people who are already tapped out. And I would argue that people are already tapped out and that we're, closer to the tail end of recession being declared at some point, barring some productivity miracle. So generally speaking, listening to a lot of economists, I don't think that the tariff threat long-term is really very large. However, Powell cannot cut rates into an environment where there's a threat of higher inflation. And for those that haven't been listening to us for years talking about this, essentially the Fed's tools with cutting or raising interest rates, they're very different for what you do if the economy is weakening, such as under the hood employment not being that strong. What do? You want to cut rates so that you stimulate the economy by getting employers to go invest in things in the future, in building and in hiring people to create a boost in that economy. You get people to go start borrowing at low rates and start buying stuff, and that stimulates. But if you have a risk of inflation, like from tariffs, and people start paying those higher costs, that those higher costs get more entrenched into the economy. And then that means that inflation lasts longer. So what do? When you have high inflation, you keep rates high to get people to finally cry uncle and stop spending to get the inflation under control. And so Powell's like, hey, no matter what threats Trump is throwing out, he's created tariffs that are giving that higher risk right now to higher inflation than the risks that we're seeing in employment and unemployment that are not great, but they're not yet urgent to act on. And so, Trump's blaming Powell, Powell's blaming Trump. The reality is the fact that he came back out, late last week, early this week, and said, hey, we have a new August 1st deadline, and they've kind of moved the goalpost again. I think it's very unlikely that the Fed actually cuts in July. And before he did that, I thought there's a chance that they start to cut because trueflation, which is a really good indicator of where real inflation is, it's down to 1.7 today. So it's below their 2% target. And you would think if it wasn't for this looming terror threat and unknown of what's going to happen, that the Fed would be cutting, that they're late, that they should have already cut. And I do think that's the case, but they're too worried about the inflation really ticking up and the consumer surprising them and paying and absorbing those additional costs. So time will tell, but I think we just kicked the can. August 1st is the new deadline for tariffs. So, they meet again, maybe in September, but I think that the tariffs take several months, Michael, to really reveal how that's going to play out. So do we get a rate cut in September? Do they push it to December? I think a lot of that's going to depend upon primarily what we see in employment and unemployment in the next couple of months.
Yeah, I think you're absolutely onto something. Because again, something I've been warning about all year, because I studied this for, for 30 years. We have this thing called the base effect,
Yeah.
which is basically how, CPI and inflation is put together. I've been warning about these 2 months, July and August, all year, because this month is actually, we had a negative print last year.
Yeah.
So last year we posted a negative 0.1. So even if inflation comes in at 2, like 0.2, inflation is going to jump 0.3, or maybe rounding 0.2, but it could go up 0.2 or 0.3% just because of the math equation. And Jerome Powell obviously knows that. Next month's not much better. I think it's a positive 1, right? A 0.1. So, and then after that, it gets easier. If you look at the base effect, after we get through August, we're talking 0.3, 0.4s. So I think there's a very good chance either the December print or the January print for December will have CPI at 2%, just given the math equation. And I think Jerome Powell wants to do everything he can to get through the next 2 months, because he doesn't want the headline, the Fed cut and inflation is up.
Yes.
So July is off the table. I've thought it was off the table for months now, but September's a possibility. If the job market cracks, and it's going to have to crack hard, because again, unemployment rate went down, right?
Yeah.
It went down to 4.1, and the Fed's calling for 4.4, right? 4.4. So it's going to have to crack hard. Otherwise, you're right. I think this might be a punt to December.
Yeah, and this is kind of what we've been talking about. We've been kind of in this stagflation-like economy where you've got the threats of inflation about as equal as the threats of recession and unemployment, really ticking up. And that is going to stay that way as long as the Fed stays still, because their tools work. They fix one side and they could potentially break the other. And that's why they're just saying, we just have to stay in this position that neither is great, but neither is terrible in terms of inflation or unemployment yet. And so I think they're just going to have to stay still. And the risk is that stagflation stays that way longer. And then the tools become relatively ineffective to make a difference. And then you've got the whole treasury market and what's happening to the dollar, and how are our trading partners going to react, with tariffs, and what's that going to do to our debt? And then where's where bond market's going to demand treasuries be? And, depending on where treasury rates are, that continues to put more pressure on, banks and individuals not to be able to loan to borrow money at rates that are reasonable. And so, we could see status quo, what we're sitting on for 6 months, 9 months more, even with continually weakening economy. And even if inflation starts to come down until they see the effect of those tariffs. So this is kind of like, I feel like it's Groundhog's Day, like for 2 years, like as many new groundhogs pop up, it's still kind of status quo, and, just continue to be patient and wait. But, we can take some lessons from the 70s, and it took years longer than anyone thought it would, for things to go back. But, my biggest concern is the recession risks have not gone away. And for, the leading economic indicators, which I like to look at, they've pretty much 7 out of 10 turned recessionary a month ago. And I haven't looked in the last couple of weeks, but the Fed and the Conference Board, who date recessions, are saying it's looking really recessionary, and it's just barely positive, and only 3 out of 10 that show growth. And so as that continues to flow through to the economy, as costs do potentially go up for tariffs, I think it's going to dump us into that recession being declared. And then, to your brief point, I know you mentioned a news article, the Fed will be forced to drastically correct, and we might be back to QE and back to basically zero rates and free borrowing again, just to stimulate us out of the economy, when it seems to, quote, suddenly be recessionary, when again, we've been in recessionary conditions in 2022, popped back out of it, popped back in, popped back out of it. You were teetering there again. And so, what we know is history rhymes, and most likely when it finally comes, it's going to seem shocking to everybody, because the stock market's roaring and people think it's a great economy and great unemployment print. But I think that recession always happens. I think we're going to have the bottom, and then it's going to be a very different world in a year from now than it is today, would be my guess.
Yeah, it's interesting. I think one of the things and we talked about this, I think 18 months ago. I think what this is ultimately going to be called is a rolling recession,
Yes.
right? It's unlike any of the others that most adults have looked at, whereas all of a sudden everything went bad. I think
Yeah.
that's what this will be called. And again, rolling recessions aren't very common, right? If you go back and
Right.
look at economic history like I have. So
Right.
you actually brought up that article. I read an article. This is the New York Fed and the San Francisco Fed collaborated on an article. And the basic article was, could rates go back to zero? So basically, two numbers from this article caught my attention. Over the course of what they called the midterm, and in their world, midterm is 7 years, they pegged the chance of going back to zero at 9%, which again is a relatively small number. But I think the fact that the Fed still thinks there's roughly a 1 in 10 chance we go back to zero is frightening, in my opinion. What do you think?
Yeah, I'm quite frankly surprised that it's that low of only a 9%, just because essentially the world is teetering on recession, and there's not a lot of big productivity miracles in the works to bring the world back to robust expansion. And so when you just look at that, like economics 101, if you don't have global productivity boosts and you have nothing to pull you out of very recession-like conditions globally, you don't have a one country savior that's going to come in and lend money to everybody else for all their stuff. We're fighting with China, who quite frankly was very involved in helping bail us out from the great financial crisis in terms of buying so much of our US debt. And so if you look just at globally and say, okay, things are not great. There, people, we've seen articles from the World Bank and the IMF saying countries are in recession or they're close. If you don't have something to stimulate productivity, what is the only option all the central banks do, Michael? They cut rates, and they cut them drastically. And things have not been this precarious since the GFC. It's not as bad nearly as the GFC. But during the GFC, it was print, baby, print, and it was cut rates drastically. So I think that they're quite frankly being disingenuous and don't want the public to
they're talking their book.
They don't want the public to think that it could be bad enough over the next 7 years that they would drastically have to go to those measures, because that would spook the bond market and the stock market to do things they don't want them to do. They want everyone to think the economy's healthy, so people keep spending, so we don't have that deep recession. And they're hoping that these tax cuts kind of stimulate enough to get companies producing and keeping people employed. And it may or may not, but I'm cynical enough, and I've been through enough of these things and read enough about history to call bull and say, their chance of going back to the zero bound. I think they could have prevented it if they had cut rates earlier. But I think they probably think it's more like 40%, maybe even 50% chance that they have to go there, unless they can tell us why they have hope and where the productivity is going to come from.
Yeah. So let me ask you this. What do you think the number is? Like and again, let's use their term, over the next 7 years, what do you think the chances are we return to the zero bound?
I think they're higher than 50%.
Wow. All right. All right.
Because again, we have the appearance of a healthy economy when 70% plus of the citizens are not healthy and are pulling back, declaring bankruptcy, credit cards maxed out, can't get loans, no longer can find jobs, but no longer on unemployment rolls. And the reality is GDP is close to 70% consumer spending. The numbers kind of move. And so if your consumer isn't strong, tell me what's going to keep us roaring again. And, the administration has plans, and we'll see whether they're able to execute them. But it is still a very global economy. And there's a lot of things that are reshifting, the deglobalization, supply chain changes, all those things are going to be very impactful. So it's not that I'm super pessimistic, but I don't see enough actual facts that show me that there's going to be a global productivity miracle. That's what I call it, because it can't just be, run of the mill. We're going to create more services jobs. We're going to create more construction jobs. Like, who's going to pay for it, who's going to buy it. And so, AI is great, and it's the thing that everybody's pegging their hopes on, but AI can actually lay off a lot of people, and it's starting, and these revolutions, the last time it was the Industrial Revolution, and then, you've got the tech revolution and the internet and all those things, but they take a long time, and usually they're quite painful for a couple of years before they really start to show the results of all the new stuff that's creating that shift. So we're talking 7 years. If we're talking 20 years from now, maybe not. But if we're talking specifically, what's the chances of a bottom in the economy in the next 7 years that forces the Fed to go back to the zero bound? I think history shows us, and where we are and where the leading economic indicators are and the global economy is, I think the chances are pretty strong that we're close to a bottom. We will bottom out, and the central banks will do what they always do.
There you go. Well, let's get on to something that I did not think I would ever talk about, and that is the nomination of what I will call a shadow Fed president. It is very clear that Trump's not enamored with Jerome Powell. It's very clear that Powell's not going to relent to the pressure from President Trump. But Powell's term ends in May 2026. And one of the things I put out there months ago is I think Trump's going to get so upset with Powell that he nominates someone, and that person goes on TV each and every day talking about what they would do, just minimizing what Powell is doing. So do you think the chances we get a shadow Fed president announced in the next couple of months is pretty high, or what do you think?
Knowing Trump and Trump being Trump, and already his, social campaign and the handwritten letter. And guess what Trump said? Here's where our interest rate should be. And he pointed to the ones that were close to zero, like we just talked about, right?
Yeah.
So the more he goes on this pressure campaign, the more likely he's going to continue that pressure campaign as he gets ready to nominate people. I don't think he wants to let on who they're going to put in place just yet. But they definitely are putting in people who they think are going to be a little more conservative, who are going to be more aggressive on cutting rates than what Powell is. And they're going to nominate, replacements to current Fed governors in order to then have them in a place where they could step in and be the new chair. So, I think there's definitely a pressure campaign. The question is whether he's really going to get somebody who's really going to do his bidding, and who's really going to cut rates. If they do see a big increase in inflation, they might get the job and then get their wits. And, there is a voting committee. So it's not just one person that makes those decisions. Yeah. I've heard some rumblings that, people are a little more, some nominees are more hawkish than Trump thinks, and some are more dovish than Trump thinks. So it'll be interesting, whether I think they'll ever really cave to politics. I mean, the laws pretty much don't allow them to do that. So whether you like Powell or not, think he's late like I do or not, there is a lot of complexity that's making them kind of hold their ground. Sure. And he is kind of proving that he is being somewhat apolitical in holding tight and not caving to the president, although some would say he's being political.
Danielle DiMartino Booth has come out with a shotgun recently. And she's like, I'm done defending Powell. He is being 100% political. She is going
and before
hard.
She said she really was pro Powell and thought he was like really not playing politics. So it's kind of a flip. So, we really don't know. But, I hope that the Fed will not be a shadow Fed and cater to the whims of politics. Because the reality is, both sides of the aisle, I'm going to get hate from both of them, right? But both sides of the aisle, in Congress and in the presidency and in every other office, they do what they do for political expediency. It's not always in the best interest economically. And quite frankly, many of them are not economists. They don't really understand the ramifications of the legislation that they pass. And so if you just have every branch, and this is not a branch, but it's supposed to be an independent agency, if they're all just going along with the winds of the day, the consequences long-term could be really bad. So I hope that we have a true independent Fed, and I hope that we can get people that don't operate with political bias and that finally tackle the debt problem, because that's the biggest risk to the American economy.
Yeah, I went out on a limb, I think I did it a month ago, and said that I thought by the end of July, so time is ticking, that Trump would nominate the next Fed president. But the question I have now is, does Trump want to nominate Waller or Bowman, basically somebody on the Fed already, or will Trump nominate somebody off the Fed? And I'm actually leaning towards off the Fed, because if you're on the Fed, you actually have to abide by the rules, and most of that being the blackout period, right? There are weeks they can't talk.
Yes.
And I think Trump wants somebody who can talk every single day.
Right.
And at the moment, I actually think Scott Bessent is the most likely nominee, mainly because Bessent's job around tariffs should be over by May. And then he could just slot in a yes man. And, that's where I think this is going. But hey, we'll see.
I don't think he wants that, though, because that's kind of a demotion from where he is now. And I think he feels like he's being very careful. He's saying, hey, if that's where President Trump wants me,
if that's what he wants me, I'm in.
This is where I need to be. This is what I want to do. But I'm willing to do what he calls me to do. So I think he can probably convince Trump to keep him in Treasury so he can control the debt and how much interest we pay on that debt, and that he'll collaborate with whoever it is that gets nominated to replace the outgoing governor. And then that person will probably be bumped to Fed. That would be my guess, but who knows? Who knows?
Yeah, it's fun.
It'll be interesting to see. But I do think that they're going to get enough ammunition and enough people that we're going to start seeing rate cuts at least end of the year into 2026.
Goldman says that the Fed funds rate will be 3% by the summer of next year. So, 12 months from now. So we'll see. Yeah. Well, let's get to the big, beautiful bill. It was signed on July 4th. That was the promise way back in Inauguration Day. Lots of talk about it, good, bad, indifferent, adding, $2-3 trillion to the debt. Don't know what you think of the big, beautiful bill, but it is law now. So, does it spark an economic renaissance? Does it cause people to, raise our treasuries because the debt's going? Where does Anna come down on the big, beautiful bill?
So first, I'm going to tell you, I was really watching what was in the House bill and the Senate bill, but I didn't get to really dig in after the Senate bill passed to see what changes are in it that I don't know, because the last week I was pretty much MIA, handling some family things. And so I didn't really dig into it. So I can't give a strong opinion other than, I think that there's some good things in it. And I think that there's some things that I wish were pulled out and dealt with separately, and maybe that would have yielded a better result in terms of what it does to our national debt overall. In general, and people will argue this, depending on what side of the aisle that you're on, but in general, it has been shown that tax cuts generally are stimulative. We are not really cutting taxes for most people. It's just maintaining the status quo. And so for the current period, not having a huge tax increase hit people when 70% of the American population is already struggling, I think is a good thing for the economy to keep it somewhat stable. Whether those cuts should have really been permanent or not is a whole nother discussion. Because if you follow Ray Dalio, which I do, and I think his arguments are quite good, looking at history, when countries get in as much debt as they have, they really only have a few options. And one of those things is to cut social programs. And regardless of what you think about the programs being cut, DOGE and the attempts of the big, beautiful bill to do things like make able-bodied people work in order to get government assistance for Medicaid, Medicare type help. I think in general, if people can work, they should work and they should contribute to our economy. And that's just fundamentally, what I believe. And so that is an attempt at austerity. And what Dalio says is when GDP, debt to GDP is as high as it is for our country, and it's sunk most countries that once were the dominating world economic superpowers, you've got to cut spending and you've got to raise taxes. And so this bill has cut some spending where I think it should be cut, although I don't know all the cuts that are there. But it's also cut taxes for certain people rather than raise taxes. And when you can't bring in enough tax revenue to cover your expenditures, the debt continues to grow. It gets worse. It kicks the can down the road. And the only other option really is there's two. One that Dalio prescribes to, which is inflate away the debt, devalue the currency. And that's what governments have done since the beginning of the time. And the second one that Trump and Bessent are trying to do is create this productivity miracle. So some of the tax cuts are there to get corporations to go produce things like bonus depreciation being back. I don't know yet, is that going to apply to real estate and cars and equipment like it did before? Or is it just for things like building manufacturing plants? So no doubt about it, giving corporate tax rates, as much as the left hates it, and some on the right don't like it either, historically, if companies will actually go out and invest in the future and invest in people, it can create a productivity boom. The question is, will it, Michael? Because companies have gotten really good about financial engineering and stock buybacks, borrowing at low cost, taking that tax saving, and then going to make profits, through financial engineering rather than creating jobs and productivity. So time will tell as to whether that's beneficial. But in general, I'm concerned with the long-term debt. The big, beautiful tax bill doesn't balance the budget. It does what Scott Bessent says has kind of been the curve. So the debt's going to continue to go up, but the hope is that it starts to flatten out as that productivity starts, and as people are making more money, then the dollar amounts they would bring into tax revenue because of an increased income level for the American taxpayer will bring in more revenue, and then they'll start to go after other ways that they can cut expenses, and then hope they can get the treasury rates down enough that we can afford the interest on our debt, so that over time they're bending that curve. Time will tell whether that actually plays out, and whether we'll look back in history and say this one big beautiful bill was actually what we needed to create productivity and get us out of debt, or whether we can say that was kind of one of the final nails in the coffin of the U.S. in terms of our proclivity to continue to spend and put us into kind of a hyperinflationary debt spiral where our money is worthless. So what I do know is that my stance has not changed on what do I want to do to combat the potential devaluing of the dollar, so that the U.S. can inflate its way out of debt when it can't, raise taxes and cut spending. Is I'm going to buy hard assets, things that preserve value, i.e. real estate, Michael, one rental at a time. And also gold and silver, things that are going to preserve value and that are going to weather future inflation. So my worries about that were not allayed by the passage of the big, beautiful bill, even though I think it has some good things in it. I think it's got some not so good things in it as well.
Yeah, Larry Summers has come out as he's just a grumpy old man, I think. I don't know. He's just always grumpy. No objective economist would characterize the big, beautiful bill as a boon for the economy. Then we have the White House Council of Economic Advisors saying that the bill could actually reduce the deficit by 11 trillion. These are, of course, over a decade, 11 trillion over a decade. Reduction is possible. I think we should all hope they are right, going from, I don't know, what is it, 38 trillion. Take off 11 trillion. That would be more than bending the curve. That would be, going one direction.
Yes.
The last thing from Larry Summers says, none of us can forecast what is going to happen with economic growth. So I agree. No one knows. Does the big, beautiful bill have enough to spur this innovation, to spur investments? The one thing I think about is the whole no tax on tips. So check my math on this. So let's just say you are someone who collects $10,000 a year in tips. Don't know if that's a lot or a little, but it's easy math. You're probably spending 20%. I mean, last year, 20% of that was probably taxed, I would guess. Seem reasonable? That's $2,000. So now if that $2,000 note doesn't go out and you get to keep it, that's almost $200 a month in discretionary income. And you and I both know people at the lower part of the income scale have a high propensity to spend.
Yes.
So that's like new spending, just like that, right?
Yes, absolutely.
Same with Social Security, right? I think they said 75% of the people that collect Social Security will not pay taxes on that money. I guess because they had to do a credit versus some other math magic.
Yeah.
But again, high propensity to spend, right?
Right. And that's what they need, because GDP is such a high percentage is consumer spending. They need the consumers to spend. They
Yep.
need the employers to spend. And so,
Yep.
that's the whole point of tax cuts. It's to try to get that productivity back. The thing that will ultimately, I think make as big of an impact on the bill itself is that if you're just looking at the bill and you're saying, what can it do? You could see some of these things. But the question is, when we also have at the same time all these global wars or edge of wars and the tariff threats, which create trade wars, is that productivity going to stay the same, or are costs going to go up equal or more so than that additional spending because of what it does to the deglobalization, the supply chain issues, and God forbid we get sucked further into war? Do things get commandeered? Do manufacturing plants get commandeered to make bullets and all those things? And this isn't me being pessimistic or me being a warmonger.
You do sound kind of doomy today.
No,
I
I'm
will
not.
say.
I'm really not. But I'm just saying the reality is there's so many things globally that can make an impact on this,
Sure.
that for people that are just like, oh, the bill's going to save us or the bill's going to crater us. There's so many intricate parts of the economy that is still global, but kind of pushing back, that it's hard to make predictions. And I think that's my point. Like, Larry is generally doomy and some are, generally too rosy. I'm really trying to stay kind of like, the reality is it's kind of status quo. It's going to take time to play out. And there's a lot of other things that could make an impact. For today, as a real estate investor, of course, I like that bonus depreciation is back, right? Because I can buy some things that'll offset my taxes. Maybe need a new vehicle for, that I would go out and buy because of the tax benefits that I wouldn't have before. So there are certain things that, I'm going to take advantage of personally, whether I would have voted for them or not. I have optimism.
Rules are rules. Yeah.
And I have optimism for our country. We just have to make some changes. And I hope that those, changes come through. And we always have to be optimistic, or we would all stop and, lay down and give up. And so, you don't bet against your country. You bet against the good. You bet for the good. And then you go out and do what you can to be productive. So instead of just complaining that you did or didn't like the tax bill, like, if it's going to help us be productive, go out and be productive. Go out and make investments that are going to help your personal economy and help other people and benefit other people by creating jobs, by creating good housing for people. And so you have to be optimistic enough to do that. You just have to be realistic enough to know that there's still a lot of tailwinds. It's not like tomorrow, because this bill passed, everything's going to be amazing and great. I think that's naive. And I think it gets a lot of people in a lot of trouble. So you just have to be wise and watch what's happening and make really good investments for today. And history shows, again, if you invest in hard assets like real estate, Michael, whether you're in a deep recession, whether you're in hyperinflation, assets tend to hold their value. If they cash flow, which is really paramount and critical for today, you're going to weather anything that comes in the economy so much better than the average person. And so I'm very optimistic on owning real estate and owning hard assets, because that's what's going to get you through, help you preserve your wealth. And also over time, as things do get better over the long term, create wealth and create a lot more income for yourselves.
Yeah. At the end of the day, folks, time to get wealthy. Again, we started with Ken McElroy telling us we're in the third inning. We have, opportunities, perhaps lower rates coming. You got to make sure cash flow is day one. Don't bet on appreciation. This is not a time to gamble. Again, if you want to be a part of folks building wealth, join the One Rental at a Time school community. 420 people go in the same direction. Anna, where can people find you?
You can find me on your show. You can find me on social media at Anna Kelly REI Mom. And if you're interested in real estate or wealth consulting, coaching, you can go to my website at annakellyinvesting.com and book an appointment with me.
Awesome. Thank you so much.